your kids would then take over the loan payments and receive the loans, and then your grandchildren would get the overall death benefit. Again, very specific. We'd love to be able to talk with you exactly how this would work for your family situation. So we have superior lending relationships. So the key factor is we work with other financial advisors and other life insurance agents, because if they're only doing one of these policies every couple years, there is so much detail and so much planning. There needs to be working with the bank every single year, making sure the collateral of the bank is there, having the relationships that we have with the bank. So, if you have a financial advisor that you work with that doesn't do these, we'd be more than happy to work with them to show them how this works. But more importantly, you don't want a financial advisor or a life insurance agent that never does it. That's why we partner with Selector, because that's all they do is premium finance, in addition to some of the other ancillary products they offer. They are the experts, and they are going to create these, as Joel was saying, with the stress tests that are involved. So you can see, obviously, some of the major banks that we work with. What we're dealing right now, here's the SOFR is at 3.62%, the bank spread of 1.25. So we're all in. Our current lending rates are about 5%. So we still feel that we are showing that 5.75 is very, very accurate. The one thing you're going to see on the next slide is lending rates versus the collared S&P 500 return. So what you're seeing here is, in this column, this is the historical data from 2005 to 2024. And this is the S&P here as far as the returns. When you're looking at an indexed universal life, you have what they call cap rates. So that means the most that you can make is wherever that cap rate is at. So if the market, in this case in 2005, did 3%, your cap was 12, you made a 3%. That particular spread minus our lending rate, you were down that year. Next year, you're actually up. But if we went from 2004 to now, you could see the average arbitrage was over 3% spread. That means you're making 3% off of the money that you borrowed. And this is really where the last thing I'll show here is that for why we like Index Universal Life as a strategy is in 2008, when the market was a negative 38%, it was actually minus 55 from top to bottom, but the year end was negative 38%. You didn't lose any money in your account. You start over that next particular year, versus if this is your investment account, you obviously knew what your portfolios did during 2008 and real estate portfolios as well. So that's why we've really kind of looked at that long term. And this is why banks love this strategy, because they know that there's never a negative year, versus if you use, for those that have used margin or use your accounts as leverage, the banks want to see that statement every single year. And it's very volatile. You may have a capital call where you have to come out of pocket, where here, your only capital call is going to be is what you're looking at here. So this is Colin Zai's information on the phone. Feel free to reach out to both of us. I know Colin was sad he wouldn't be able to make it. We're talking last night, he couldn't get out of Newark. My phone number is 813-807-0391. But at this time, we'd love to answer any questions. For those that want to scan the QR code, please scan the QR code on the right-hand side with your phone. We'll kind of pause there. And please, if you either want to raise your hand or use the Q&A section, we'd love to be able to answer any questions for you. And again, most importantly, we want you to understand is that we're here to help you build a lasting legacy, whether it's building income now or building a legacy. And we're also trying to help you disinherit the IRS when it comes to the estate taxes. Because right now, that $30 million exemption is a lot higher than it's been in years. When I first got into the industry back in the early 2000s, it was $500,000. So we don't know where the estate tax issue will be at in the future. What we do know is we can start planning on what does that look like on the life insurance side. So feel free to reach our team at 866-971-6221. And also in the chat, you can click on the link in the chat as far as be able to schedule a phone call with us as well. So any questions, feel free to raise your hand and we can bring you off microphone. So one of the, I'll ask a question is, and Joel, you can chime in on here. One of the things that when you look at why people think there's a lot of risk with premium finance is the lending rate. So Joel, you want to talk that, and Kishore, we'll come to you right here. One moment.
Yeah, the obviously the program is obviously borrowing money, so there's a lending rate involved, and for high net worth individuals especially, they can typically get really attractive rates from their private bank or again these premium finance specific banks. Even in a high interest rate environment, it typically means that the life insurance carrier itself's general account also does better. So, in a high interest rate environment, the life insurance world also typically increases caps, which ultimately increases that potential arbitrage spread as well. And then, as Michael showed you, these are long term plans in nature. So, that arbitrage over the 20-year period of the 3.6%, it truly does stand up. One thing is that, we sort of like to stress about is you can't go into these type of programs with even 5 or 10 years in mind. These really, especially with income and those type of scenarios, you need to let that arbitrage really work to ultimately be able to pay back the bank. So these are legacy plans and long-term strategies.
Yeah, great point, Joel. And you were mentioning on the cap. So just to like, I got in working with Index Universal Life right around 2009, 10 time frame, and that's kind of where the average cap rates were at. And you can
Yep.
see here that they did start going down, and then they are right around about 10% right now. So that does directly affect of where the borrowing was at. So you could see here, obviously, when rates went lower, so did the cap rates there. When rates go higher, the cap rates end up being a little higher as well. So yeah, thanks for that one, Joel.
Cool.
Let's see, Kishore, I'm gonna if you'd like to come off, we're gonna allow you to talk and ask the question. And yes, there will be a recording. We're gonna be sending out